All right. Good morning. My name is Costis Maglaras from Columbia Business School.
Hello, I'm Rama Cont from the University of Oxford.
All right. And today we're going to give a quick tutorial on market microstructure for electronic limit order book markets. And I think both Rama and I will pay particular attention to some issues of queuing and how they actually enter sort of trade execution problems in financial limit order books. So I'm going to start and then I'm going to pass it to Rama in the second half of the talk. So I'll give a quick overview of algorithmic trading just to set the tone. Then I'm going to talk about limit order books and then start highlighting some queuing control problems that arise there. And I will try to sort of connect to operations research to the extent possible. Now, just to understand since it's a caricature of the market, you can imagine a portfolio manager, let's say a mutual fund manager managing our retirement savings, decides what to buy and sell. Then they send an order, that's typically a portfolio, and that enters into an algorithmic trading engine. So this is a computer that has algorithms that decides how to execute that order over the span of a day. Typically, they take an order, let's say to buy 100,000 shares of Microsoft, they chop it up into small blocks and they start sending it into the market. The market itself is many markets. You know, we have heard of NASDAQ, of the New York Stock Exchange, ARCA, BATS, a bunch of others. There are 12 exchanges in the US. And then there are about 40 what we call dark pools. And you can actually buy and sell shares of that stock pretty much on every one of these venues. So when you're trying to send an order for 100 shares or 300 shares of that security, you have to pick where to route your order. So that's one issue that we're going to grapple with in the next sort of set of slides. And then who you're trading against? Well, you're trading against other people like you that want to trade the opposite position. So they want to sell and you want to buy. Or you trade against market makers that are intermediaries sort of buying stock from you and selling it to someone else later on. So this is roughly speaking a caricature of the market. And the markets are electronic. They are decentralized and fragmented. So I just mentioned there are multiple exchanges. Exchanges, the ones that we know by name, like the New York Stock Exchange, NASDAQ, that are lit, as we call them, that you can see the limit order books, account for about 70% of the volume today. And about 30% of the volume prints or trades off exchanges in dark pools. Now, if you think about and the intermediaries that give access to these markets are what we call broker dealers. So in order for you to access the market, you need to go through a regulated entity, and that is a broker dealer. Now, one way to think about market participants is there are institutional investors like the ones that the mutual fund manager that I was mentioning earlier. There are market makers that are there to facilitate trading amongst us. There is retail flow, individuals like us from our personal accounts trading on securities that until recently didn't account for too much of the volume, but the last 7 months there's been an increase on that, at least in the US. And then there are what I call opportunistic or active liquidity providers. So imagine that we're all today decide that we're going to sell oil stocks. Well, somebody has to step in and buy them. So once the price of these companies start dropping, eventually somebody will step in and decide to take the other side. So that the market clears. And these typically are what I call opportunistic, active, or systematic liquidity provision. Now, institutional investors, when they execute, the portfolio manager comes up with an idea. The idea is I'm going to sell these oil stocks. and then they give it to a trader to execute. Typically, this trader has a mandate to execute that order. So the trader cannot call back the portfolio manager and said, look, I decided that it wasn't a good idea, so I didn't execute your trade. So they have to execute, and typically they stick it into an algorithm, and that algorithm tries to sort of give some best execution quality. So if you're buying shares, I want to buy them with sort of at the best possible price. So I don't want, the minute I start buying stock, the prices start going up. So I don't want the prices to go up by too much. And if I'm selling, I would like the prices not to drop by too much. Okay. And so I want to access the market. I want to get access to liquidity. And I'm concerned typically about information leakage. If I'm buying a lot of shares or if I'm selling a lot of shares, I don't want people to understand that this is happening, because otherwise the prices are going to move. Now, the way that we execute, if I want to execute a big order, is, as I said earlier, is I'll have to chop up my order into small chunks. Here is an illustration as to why. So typically, the average daily volume for an S&P 500 security is less than 1% of the market capitalization of the firm. So if the firm is worth, $10 billion, typically the stock trades about 1% of its market cap. So $100 million worth of shares are changing hands on any given day. If you look at how much quantity is available to trade immediately, at the top of the book, we'll get to what that means in a second, that's about 0.1% of ADV, of the average daily volume. So that's about 10 to the minus 5 to 10 to the minus 6 of the market capitalization of the firm. So now imagine I'm an investor and I want to build a big position in a firm. Well, there is never a lot of liquidity available. So if I want to build a big position, I will have to trade over time and I will have to sequence my execution. All right. So that's something to keep in mind. Market makers have very different considerations. So typically, they just provide liquidity as intermediaries. They don't hold positions for a long time. And they're concerned with things like adverse selection. For example, you wanted to sell the oil stock. I bought it for you, but then you were selling so much stock that the price went down. So when I try to sort of unwind my trade, I'm going to lose money. So I was adversely selected in the sense I didn't know that there was a huge trade coming, and I bought it for you just for, let's say, 1 penny below what you were willing to sell. And I thought I was going to make money, but then the price dropped by $0.50. So they're particularly concerned about that, and they have sort of very sophisticated technology to try to sort of hedge against adverse selection. So algorithmic trading systems. So when we try to trade that big position, let's say unwind $50 million worth of ExxonMobil, what we want to do is we want to build forecasts for all the market variables. How much volume trades in ExxonMobil at any different points in time? What are the bid-ask spread? How volatile is the stock in the morning versus the middle of the day or the end of the day? What's the market depth? What's the available liquidity at any point in time? So I would want to build all of these things. I want to build signals that maybe directionally will help me accelerate or decelerate while I'm executing. And then I want to solve some kind of optimization problem that tells me how to sequence my trade between, let's say, 9:30 when the market opens and 4 p.m. when the market closes here in the US. And maybe I'm going to split my parent order, as I call it, into small slices, 5-minute slices, 10-minute slices. And the relevant time scales here in trade scheduling is minutes to hours. All right. So I'm solving a problem that will last for a long time. And I'm going to chop it up into small chunks. And I'm thinking about how much cost, what's my execution cost or market impact when I execute. Then I'm going to take these 5-minute slices and stick them into what we call a micro trader. And this is someone that will take, let's say, I want to sell 100,000 shares of ExxonMobil. Now, over the next 5 minutes, I want to sell 10,000 shares or 5,000 shares. And now this module will chop up the 5,000 shares and send some at NASDAQ, some at the New York Stock Exchange, some at ARCA. It will place them at different price points, and it will manage, let's say, the short-term dynamics of the limit order book. And that's really what we're going to be focusing on. And an additional consideration here is that issue of order routing. Do I send it to NASDAQ or do I send it to the New York Stock Exchange? So these are the two problems that we're going to be looking at in our journey to understand limit order books. So I mentioned forecasts, and what I want to do is show you some pictures rather than talk much about it. So this is volumes. So these are the S&P 500 security universe. And this shows what fraction of the overall day's volume trades in any given different minute. So these are minute bins. There are 390 minutes in a day. And you see it starts with a little bit of a spike because, you know, we just wake up, there's some news. So when we start trading, there is some increased amount of trading, then it flattens out, and then there's a lot of activity that takes place towards the end of the day. All right, so that's essentially the behavior of volumes during the day. This is the behavior of volatility. So when we start trading, there is a lot of volatility in the day because, you know, sort of a lot of news get released overnight and before the opening of the markets. So the stocks are very volatile very early on, but then volatility sort of declines because, you know, news are absorbed in prices, and then it flattens out throughout the rest of the day. If we look at the spreads, so this is the difference between the offer or the ask and the bid. I'll show you a picture in a second. The spreads are also much wider in the beginning of the day because there's a lot of volatility and we don't quite know how the market is going to open. And then it tightens during the rest of the day and it becomes sort of much more narrow. And that's the last plot I'm going to show you of these variables. And this is how much liquidity is available at the best bid or the best offer at any point in time. And I've normalized it by the average daily volume. And during most of the day, you see that that's hovering around 10. That's 10 to the minus 3 of average daily volume. So 1,000th of what trades throughout the day is at any point in time available for you to execute instantaneously. Towards the end of a day, this increases by a factor of 2 or 3. And in the beginning of the day, because there's a lot of volatility, this is significantly lower because market makers are afraid to post a big position because the markets are moving by quite a bit and, you know, they may lose more money. So these are some of the variables that we would build forecasts on. And now let's look at the limit order book. So this is a picture of a limit order book. And so the green orders are bids. These are offers to buy stock. And the red orders are sells. These are orders to sell stock. And in this picture, $100 is the offer or the best offer. So essentially, this is the lowest price at which people are willing to sell these shares. And $99.99 is the best bid. So this is the highest price at which people are willing to buy stock. Each price level, each penny here, each price level is a queue where people are waiting, orders are waiting in a first come, first serve manner. So the person that put the order first is the person that is at the top of the queue, and then and so on. Orders may get canceled at any point in time. So I may decide I don't want to wait anymore. So I'm going to cancel my order. And orders may actually trade against arriving market orders. So here we see one order to sell, the red one that shows up at $99.99. This is an order to sell 4 lots at that price. And what it's going to do is going to start consuming some of this bid quantity that is at that price level, first from the person that is at the head of the queue, and then moving up the queue until the quantity gets depleted. All right, so this is called a market order. This is the same picture, but I've now plotted it, and I'm going to sort of do a sequence of plots to connect to a queuing model. So each of these price levels shows some quantity. This is going to be a queue. People submit orders in each of these queues. People cancel orders from these queues. And occasionally, people send market orders to cross the spread. So, you know, the picture, the blue queue with the highest price called the bid, the best bid, and the green queue with the lowest price called the ask or the best offer. And the bid-ask spread is the difference between these two price levels. And when people cross that spread to trade instantaneously, they either send market buy orders or market sell orders. All right, so this is the same picture, adding some terminology. So, you know, lambdas are arrival rates of limit orders into these queues. These depend on the price level. There are some cancellations that are happening. That could be constant or could be something else. We'll return to that in a bit. And then there are rates at which market orders are crossing the spread to trade against these limit orders that are resting in the price levels. I will redraw that, and I will redraw it now in the context or in the picture that looks like a multi-class queuing system. So you see there is one side of the book where orders are waiting to buy, and there is another side of the book where orders are waiting to sell. The market order rate, so this is the rate at which mu S is the rate at which market orders are coming in to sell stock, and these are sort of trading or clearing the queues that are waiting on the bid side of the book. Okay, so that looks like a multi-class queue. It's served according to a strict priority rule, according to price. And then within each price level, it's FIFO. All right, so that's how this side of the book looks. And then there is a corresponding side of the book on the sell side, the green queues that are served by market orders to buy. In principle, and we're going to see that in a bit, all of these lambdas and mu's are actually dependent on each other. So there is coupling between these two systems. And as we mentioned earlier, there are multiple of these systems. There is the New York Stock Exchange, there is BATS, there is ARCA, there is NASDAQ. So there are multiple of these in the market. All right, so that's sort of a limit order book. And this is how the multiple limit order books look across exchanges. We will return to that in a bit. Now, I want to start thinking of an execution problem and how would that look in a limit order book. So what I would do is I would sort of obviously be making real-time measurements of everything, all of these parameters that I was mentioning. I would know all of the queue levels, and I would probably use a model that I will explain in a bit, where I try to understand who am I trading against and what they're doing. Because there is this FIFO, time price priority in the limit order book, every time I place an order, one important thing that I need to do is I need to measure or estimate how long it's going to take me until I get to the front of the queue and I execute my order. Or if I say I only have 60 seconds until I have to do something else, what's the probability that my order is going to get filled? So placing limit orders into the market depends on queuing effects. How long is it going to take? How long do I have to wait at NASDAQ versus BATS versus New York Stock Exchange? If I place an order right now, 10 seconds later, I need to perhaps estimate or maintain where am I in the queue. I used to be the last person in the queue. Now I'm 2 queue positions ahead. So I only have 4 people ahead of me, etc. And then finally, I want to be thinking about transaction costs, how long, by how much am I moving the price simply by placing my orders. I want to think about adverse selection. So every time I trade, do I regret it because the price moves away, or is that a favorable trade? And then, I want to sort of build a control algorithm to decide when to send orders to the market, at what price, at what exchange, and want to change all of these decisions. So the typical control problem that we're thinking now here is one where the horizon of the control problem is sort of the same order of magnitude as the queuing time, right? So because I'm making queuing considerations of placing orders, waiting for them to trade, it's natural to think of a control problem, and it's what people do, where the time horizon, you can think of it as a small multiple of the queuing time. So if the queuing time is a minute, I may be thinking, 1, 2, 3, 5 minutes. I'm not thinking for 60 minutes, because if I'm thinking for an hour, I have to think about slightly different things. What's the volatility half an hour from now? But if I'm thinking of the limit order book, whose state is changing quickly, I want to be thinking in that time scale. So I'll skip through this slide because we're going to return into the routing aspect of things. But I want to make again the point that queuing delays is important for the institutional investor when they're executing. They're also very important for the market maker because when the market maker places an order and waits for a minute or 30 seconds or a minute and a half to get filled, market maker is exposed to news or things that may change prices, and in some sense may be adversely selected. So that's sort of the key aspect of it. And from a queuing OR perspective or stochastic modeling perspective, we want to be thinking of multi-class queues. We want to be thinking of things that are coupled on the buy side and the sell side. We want to start thinking about the fact that market makers and institutional investors like Vanguard or Fidelity trade in a very different way. And we want to be thinking about how should we be modeling these systems. These are very high dimensional systems and strategy interaction. These are sort of strategic interactions between market participants. So we want to really kind of try to think about that. So here are some pictures about limit order books, and this is the S&P 500. For each stock, I have 3 dots. The green dot is how many events are happening of a particular type. These are trades for green per second. So you see that for liquid stocks that are sort of 0.1 and sort of to the left of the graph, you see that we're having 5 to 10 trades per second. That's how quickly trades are happening, average over the span of a day. The green dots in how many, for the same security, how many limit orders are arriving at the top of the book, at the best bid or at the best offer. And you see there, this number, instead of being 5 to 10, is about 20 to 30. And then the red dot is how many of these limit orders that get placed at the top of the book get canceled. All right, so the main thing that we should observe here is that the number of trades that happen, the green dots, are much lower than the number of our limit orders that get placed, the blue dots, or the number of the orders that get canceled, the red dots. Plotted differently, here I've rescaled everything by how fast we're trading, and you see that the cancellations, these are the red dots, are hovering between being 3 to 5, or in some cases 10 times higher, faster than the rate of trading. And arrivals are also 3, 5, 10 times faster than the rate of trading. So this is something that is important to know. There are many orders arriving at the best prices. There are many orders that get canceled at these price levels, and there are few orders that get traded per unit time at these price levels. So this is how the limit order book behaves. This is exactly the same plot, but in the bottom one, I've plotted it in log scale, and you see that there is almost 1 order of magnitude difference in the speeds. The green dots versus the red and blue dots, they almost differ by 1, and that would be essentially 10 times faster. This is not exactly 10 times, but that's roughly speaking what we see. Okay, so that's important to remember. Now, the last bit of pictures here that I want to show you. This is an interesting website. It's called Midas in the SEC. You can go and check it on your computers. It shows you this is one particular set of plots. It shows inter-arrival times between different things that happen in the limit order book. So the top one is trade frequency. So this is how much time it took between one trade and the next trade. There are some trades that happen instantaneously, and that's why there is a sort of a delta function at 0. But then you see there's sort of a hump that doesn't look random around 40 microseconds. So in 2017, that was roughly the technological performance limit. So a lot of people could react over the span of 40 microseconds. The bottom plot is cancellations. So how long does it take between one cancellation of an order versus the next cancellation? And you see sort of 2 statistical signatures. One's at 40 microseconds and the other one at 20 microseconds. It's also interesting to see at this plot that about 9% of all orders cancel within 100 microseconds of each other. So when you're looking at the movie of events happening in the limit order book, you know, even though we say 10 things happen per second or 5 things happen per second, they don't happen randomly in equally spaced, but typically nothing happens for quite some time, and then 122 things happen almost immediately, and then nothing happens, and then a bunch of things happen immediately again. So that's something to remember. If I look over the span of a second, okay, as if a second is a long time, you realize that there is sort of predictable behavior here. You see these spikes every half a second in the top plot. There are people that do trades every half a second. So they have an algorithm that says, send an order every half a second. Well, if they do that a lot, then you will see that in that frequency plot. The same thing with cancellations. Interestingly, about 30% or 32% of all trades happen within 1 second of each other. In terms of cancels, it's about 54%. So there's a lot of activity that happens over short time periods. Now, one question is the extent to which the system is stationary in terms of its parameters, and because this will have something to do with how we're going to model the system. So here I've done something that is sort of trivial, a trivial check. So I'm going to measure how fast are events happening at any point in time. I'll also have a measurement of volatility in these rates of events. And then what I'm going to do is I'm going to form a confidence interval. So I have a best guess for how fast trading is happening in this minute. I'll put a confidence interval that is plus or minus 2 standard deviations or plus or minus 3 standard deviations around that estimate. And then I'm going to see 1 minute, 3 minutes, 5 minutes into the future, how often is the next measurement of speed in that confidence interval. Confidence interval, I'm being a little bit loose here. What you see is that 79%, if I look at the first row, almost 80% of the time, the net parameter that I'm estimating next minute is within plus or minus 3 standard deviations of the parameter of the previous minute. If I look 3 minutes into the future, then the parameter, the speed of trading, is within plus or minus 3 standard deviations, 50% of the time. And then as you start going 5 minutes or 10 minutes into the future, you realize that most of the time the parameter has changed. Now, how important is that? What's the interpretation of 1 minute or 3 minutes? Average queuing delays, if I stick my order into NASDAQ, let's say I want to buy Cisco shares and I put an order for 100 shares of Cisco at NASDAQ, and I'm going to wait until I get to trade, we can ask ourselves, how long is that waiting time? Well, it turns out typical waiting times are of the order of 1 to 100 seconds. Okay, so roughly a minute or less. So these tables suggest that parameters stay constant for a time scale that is of the order of the queuing delay, right? But not much longer than that. All right. So if you're thinking for 15-minute intervals or half-hour intervals, limit order book parameters are going to change many times. Okay. So if I'm going to build a model where I'm going to use these mu's and lambdas and gammas that I had before, maybe that model should have a horizon that is short, is of the order of the queuing time itself. Okay, so that's sort of the point that I wanted to make here. So the last plot that I want to show here is how often do parameters change? That's another way of thinking about it. Or how often do queues get depleted? All right. So I can measure, I can go in the limit order book and see how often does the best bid or the best offer change in terms of its price, and then compare that to what I call average queuing time. And what I get is that the tick period, this is the time that prices change, is in fact almost a little bit shorter than the queuing delay. So there are other things that happen in the limit order book. And we need to know that queuing times and other events that may change the prices in the limit order book also happen at, roughly speaking, the same, this sort of roughly the same order of magnitude. So in particular, queuing delays are not much longer than queue depletion times. Okay. All right. So rates of arrival and cancellations are much higher than the trading rates. We need to model cancellations because this is important. Price changes are happening on the same time scale as queuing delays. And events rates, these parameters, stay constant for a time scale that is sort of roughly proportional to queuing delays. Okay, so that's, roughly speaking, are the models, the assumptions that we're going to work with. Now, how do we model things? There are a couple of things to say here. First of all, the simplest thing to do is to say, maybe we're going to have a Poisson model where I'm going to have rate functions. So it's a Poisson driving model, and maybe I'm going to have a function that's sort of lambda, that's a rate function that maybe depends on the time of day. So in the morning, there are more things happening. In the middle of the day, there are fewer things happening. Towards the end of the day, there are more things happening. It will depend on the price level. It would depend on the distance from the best bid or the best ask. It will depend on how many people are there already. It will depend on the effective tick size. So essentially, I have plotted pictures where the price levels are 1 penny apart. And this is how limit order books look. But if you're trading a stock that is worth $1,000, if you deplete the best ask, it could be that the price is going to jump by 20 pennies rather than 1 penny. And I call it the effective tick size. So that may sort of trigger or factor into these rates, the rate functions. The next thing that we may want to do, in addition to sort of having these in line, is we should try to think about strategies. Maybe we should model how people trade in the market, and we should think that this person is likely to be a high frequency participant because they responded extremely quickly to some kind of event, and I should tag it as an HFT order versus an algorithmic order that sends orders, let's say, every half a second or something like that. And maybe we should model jumps or bursts of events using some kind of mathematical device, and Rama has done good work on that, but I think we're not going to be talking about it in this tutorial. How big are trades? So I mentioned a little bit about limit orders. Now I want to think about trades. So again, trades are coming in. Typically, most trades are small. They're coming in round lots, so 100 shares, 200 shares. There are some cases where, you're getting odd lots, as I call it. So these are quantities that are less than 100 shares. And this is not a negligible set of orders. The other thing that when you study trades is important to remember is that imagine that there are a bunch of limit orders waiting, let's say each with 100 shares waiting at the best bid, and I send a big order to sell that can consume, let's say, multiple orders. Because there are 3 resting orders for 100 shares, and I want to sell 300 shares. So I'm going to trade against all of these. And when I look at the trade times, when I look at the trades, it will look like 3 independent trades happen simultaneously. So when I actually study sort of the behavior of these trade sizes, I should do things like rolling up trades that happen instantaneously, simultaneously, or maybe they happen across different exchanges, but over very short periods of time. Oftentimes, I want to think in dollars rather than shares, but not always. Trade sizes, once you do this roll-up that I was mentioning before, look like log normal. That gives a reasonable fit. And another thing that I think is important to do is to decompose orders depending on what I call they're event driven. Okay, so these are orders that I see something happening and almost instantaneously, 40 microseconds later, I send my own order to the market. That's an event driven order versus I send an order every few seconds to the market. So that's kind of a flow order. So I want to think about that. And in addition to that, I want to think sort of strategically how all of these things interplay and how they depend on the state of the book. So some of the orders are state dependent, and we need to sort of remember that. Cancellations. So I mentioned earlier on that there are a lot of cancellations. But when I'm about to work, let's say, on a control problem, I want to sort of address the question of what should I do with that, right? So the simplest thing to do is to say, well, you know what? Yes, there are a lot of cancellations, but I'm just going to forget about them because they're too complicated. The second thing that we can do as queuing folks is we can say, look, the simplest model of cancellation is one where I stick an order into the book. It waits for, let's say, an exponential patience time, let's call it C, and then there is some, once my patience gets depleted, I cancel my order. So if you look at the drift out of the queue, that will be proportional to the queue length itself times the rate that characterizes that exponential patience time. We can also, if we don't like the exponential model, we can have a slightly more general distribution for patience times, and we can work with that. We can have sort of a state-dependent cancellation rate. So maybe we have something that depends on the queue size, and that may be sort of a reasonable model depending on the algorithms that generate these orders. The third way of modeling cancellation is to say, well, the exponential alarm clock idea is too complicated. So I'm just going to say, look, there is a queue length at the best bid or the best offer, and there is a drift out of that queue that is constant, eta, let's say. This is state independent. So essentially it says that the same number of orders are coming out of the queue, independent of whether the queue is big or small. So that's not good as a feature, but it's more tractable. So, maybe we need to think about that. And then the last thing I want to mention is that maybe we should model things as being event-driven, and something else. So it turns out that as we saw in the plots that I was showing you from Midas, is a lot of cancellations are happening very short times after something else gets canceled or trades, like of the order of 20 or 40 microseconds. And that signature accounts, it turns out, for almost 75% of all orders that get canceled. So the reality is maybe we should incorporate the fact that there are some people in the market that don't use an alarm clock, but are constantly monitoring the state. And the minute they see something scary, they're out of there almost immediately. And then there are a bunch of other people that, let's say, use alarm clocks. Okay. So maybe I should differentiate between the two. Now, I'm going to essentially keep drilling a little bit on that point. And, you know, I'm not going to necessarily go through this slide too much, but I want us to sort of make one observation. And the observation is that different market participants sort of typically exhibit different behavior in how they send orders to the market, their limit orders or the market orders to trade. When do they cancel their orders? And an interesting thing for us to consider is it worth modeling that difference or heterogeneous behavior? From the point of view of queuing, by the way, this is an interesting thing to consider. And I'll give you an example over essentially the next 10 minutes or so. But it's interesting in the following sense. Even when we have multi-class queues or multi-class systems where we say there is type 1, and let's say they're canceling at rate gamma 1, there is type 2, they're canceling at rate gamma 2. These are models where there is sort of multi-class behavior, but it's not drastically heterogeneous. So we're all canceling with alarm clocks, but your clock is faster than my clock, okay? Here, I'm trying to suggest a difference where I'm having some people sending orders that are canceling with alarm clocks and some people sending orders that are canceling based on a stopping time. Or some people are sending small orders to trade and some people are sending huge block orders to trade. So maybe we should be thinking of these things differently, all right? So I'm gonna now solve a simple problem, and the simple problem that I'm trying to get to is how do I estimate how long is it gonna take after I place my order until it gets executed, all right? And that's in some sense one of the most basic building blocks. And I wanna do that to highlight a couple of points before we move on. So the sort of simplistic model that I have in mind is I wanna buy, let's say, a block of shares, let's say 10,000 shares, and I have 5 minutes, and I wanna buy them obviously at the best possible price. So what I'm gonna do is I'm gonna choose how much to trade, how many of these 10,000 shares to trade, when to trade them, what prices to trade them. We have already said that there are limit orders and market orders. So limit orders have to wait. So the question is, where do I go and wait? And the market orders can trade instantaneously, but they have to cross the spread. So they pay a premium or a price penalty for that. So how do I do it? Do I send small orders all the time? Do I send a big block? Do I trade with limit orders? That's the control problem. So you can imagine that I can formulate such a stochastic control problem. And I want to think of a time horizon that is of the order of minutes, which is the same order of magnitude as queuing delays. And I want to go into the limit order book and start sort of looking at the microstructure in order for me to optimize that problem. It turns out this problem, this control problem and the queuing implications of that problem is sort of the crucial building block in algorithmic execution systems. So this is a picture we had before. And so this is the picture that I want to have. I want to be measuring all of these parameters. Somebody told me to buy 10,000 shares over the span of the next 4 minutes. And I want to decide whether I stick my orders in the blue queues, whether I cross the spread, and trade against the green queues, whether I send a small order so that the queue doesn't get depleted, or whether I send a huge order and clear out the entire price level. And I want to do that over the span of 3 to 5 minutes and essentially trade at the best possible price. So one of the key things that I want to do right now, which is the sort of the most trivial thing, is I want to place an order and I want to estimate how long is it going to take until my order gets a trade. Now, if you think about it, there's some things that I need to be thinking. First of all, I stick my order there and I wait patiently until other orders ahead of me get to execute, and then I get to the front of the queue and the next order trades against me. While I'm waiting, things can happen. Maybe a large trade can come and sort of trade against all of us and move the price, let's say, down if I'm buying. So now I would have bought at $100, but had I waited for half a minute, I could have bought, let's say, 20 cents lower price. The other thing that can happen is I'm waiting patiently in my queue, but the price may move up. So now I have to chase it and trade at a higher price. It's called opportunity cost. So the first thing was adverse selection. The other thing is called opportunity cost. I need to think about who is behind me in the queue, who is ahead of me in the queue. I want to think about equilibrium behaviors. I want to think about where do I route my orders. And I want to sort of do that in a way that is tactically smart. What we're not going to do today is think about how all of these things affect what I call market structure and regulatory frameworks and market equilibria. So the simplest possible thing is stick an order in a queue and try to estimate how long does it take until it trades. Related questions is, I place my order right now and I'm going to wait for a while. And let's say 10 seconds later, I want to be able to guess where I am at the queue. 10 seconds ago, I was the last person in the queue. And now over the next 10 seconds, some people have traded from the front. Some people have canceled. I don't know from where, maybe I do. And some people have placed orders behind me. So I want to be able to know where I am at the queue, and in particular, how many people are ahead of me. And based on that, I want to be able to estimate my residual waiting time in the queue. All right. So this is relevant. This is sort of the simplest possible thing to do to solve the control problem that I was mentioning earlier. So now let's look at a couple of examples of how this can be worked out. So the first thing is I can look at how many orders are ahead of me. I can disregard the cancellation rate. So this is the green portion. I put my blue order. The green order is who is ahead of me. Nobody's canceling. So I'm going to say, I'm going to look at how many people are ahead of me. I'm going to divide by how fast the queue is trading. And that's my sort of naive estimate. All right. The second estimate, which is a little bit more sophisticated, is to say, look, I'm going to model cancellations. And I'm going to say people are canceling exponentially fast. This is the exponential alarm clock idea. So while I'm waiting, some people are trading, but other people are canceling. So I'm going to trade faster. And I can solve that. And if you do like a simple fluid model approximation for that, you get this formula of the logarithm. Okay. So, you can, we don't have to derive it, but you can write down how fast the queue length is changing ahead of you based on the trades, that's mu, and the cancellations. And then you can solve for how long is it going to take until this thing gets wiped out. Now, we can go in actual data and we can see which one is closer to reality. So this is an actual data set. These are orders placed by a machine, an algorithmic trading system, about 8 years ago in about 500 symbols. And for each of these orders, we know exactly what was happening at the limit order book. Where did you place your order? At what price level at the top of the book? And we know how long it took until it traded or it got canceled. Okay. And here's what we get. the blue in the bottom would have been the approximation, okay, if orders were canceling exponentially, okay? So let me just say the y-axis is forecasted delays and the x-axis is actual delays after they have been uncensored. And you know, if my forecast was equal to the actual trade, then I would get this 45-degree line, because the axes are a little bit different. That's the sort of black dashed line in the middle. So if my estimates were right, I would be lining up on that line. Now, if I estimate things using the exponential alarm clock idea, the blue line falls way below the dashed line. So essentially the blue sort of part of the graph. So if I assume everybody's canceling ahead of me with exponential alarm clocks, I will tend to estimate things that are very short. Okay, I will always tell you that you can trade in 30 seconds or in 50 seconds or 100 seconds, even though that's not true. If I assume that nobody's canceling, this is the red part of the plot, then I will always be quoting something that is too big. All right. So the reality is disregarding cancellations is wrong, and assuming exponential alarm clocks is also wrong. It will bias your result. You will be too optimistic. Now, the reason for that, or the explanation for that, and I'm going to show you a small solution, is that there are many orders that get canceled, but not all orders follow this alarm clock. Some people follow alarm clocks, okay? But maybe some other folks follow some kind of state-dependent method. These are the market makers. And disregarding cancellations altogether just doesn't seem like a smart idea. And assuming that they're all exponentially distributed doesn't seem like a smart idea. If you assume that it's state independent, but there is a constant drip of orders ahead of you, that's also not a good idea. So let's sort of dive into it. So I wanted to show you a few more pictures, and then I'm going to end my part and pass it to Rama. But so the main thing here, what I did is, this is again actual data. So I looked at for each stock, I have normalized on the x-axis. This is a log scale, is the Q size normalized by the average Q size. So when it's 1, that means that Q length was roughly speaking equal to its sort of daily average or sort of period average. If it's 2, it means that during that period of time, let's say that time interval delta t, the Q length was much longer than it should be. And if it's less than 1, it means that it was shorter. Now, on the y-axis, we have on sort of the left side, we have cancellations. These are the gray dots. So these are actual shares that were canceled. And on the sort of right side axis, I have the same cancellations, but I have them normalized by the Q size, okay? Now, if the exponential clock model was right, then cancellations over a period delta t would be gamma, this is the rate, multiplied by the Q length. All right, so that's what we expect. So if I take this number of shares and divide it by Q of t, which is the Q length, I should get gamma, I should get a constant. All right, so if the exponential clock was roughly speaking right, I should see my red dots being roughly speaking constant across Q sizes. But that's not what I see. And in fact, what I do see is as the Q length gets smaller and smaller, the cancellations actually accelerate quite a bit. And the reason this is happening is that we have these people that are canceling every 20 microseconds or 40 microseconds or 100 microseconds. So they see something and they're out of there. And that cannot be captured through an alarm clock. That needs to be modeled as a stopping time. So this is an important phenomenon. And it turns out if you go to the data, you'll realize that this accounts for a disproportionately large number of cancels. And in some sense, a lot of these people, market makers in particular, these are the people that we're talking about, will cancel when the queue length becomes small. So when the queue length is small, these people will just get out of the queue quickly. So let's see how that can be modeled. So what I'm going to do now over the next 4 slides is show you a very simple model. And that is, I'm going to assume there are some people that have alarm clocks, like I said before. And then there are some others that cancel when the queue length becomes very small. And there is a threshold theta. And I'm going to try to estimate how many of each type are in the queue. And then when I stick my order inside the queue, I'm going to, now I put my order at the back of the queue. And what's happening is some people are never canceling and some people are canceling exponentially. And I'm going to have to follow them and solve a differential equation to figure out how long is it going to take for my order to trade. So I can do that calculation. I'm not going to bore you with that. And I can get a slightly different formula. And I'm just going to show you the results. So these are the green dots that you see in that plot. So the main thing that I want you to get out of that plot, and I know I've skipped all of the details, is that the green is closer to the dashed line. And essentially, what I need to do is I need to model the heterogeneous behavior of orders inside the queue. And I need to understand that some people cancel perhaps using an alarm clock, but some others don't do that. And in particular, they cancel based on some kind of state-dependent rule. And here, the simple rule that we had is if the queue length gets too small, then it becomes dangerous and people cancel immediately. So, and if you do that, you get sort of more accurate results. So the rough intuition is the following. I would like to estimate what fraction of the market participants are patient or let's say market maker type of flow versus exponentially canceling type of flow. And there is a typo in the slide here. I want to incorporate that crowding phenomenon in my queuing analysis, right? And I need to sort of then do some kind of calculation to figure out how long is it going to take me, given the fact that I'm waiting behind the market makers that all need to trade, but some of the other people that are ahead of me are going to cancel. So these are the types of things that we may want to consider. So I want to leave you with the following parting thought. The first thing is trade execution involves control problems that ultimately involve queuing phenomena because they happen in limit order books, and queuing phenomena are important in limit order books. Characterizing queuing behavior is important, and it ends up being one of the most crucial things that happens in algorithmic trading systems. And as a result, I think us as operations researchers need to be there to help design these algorithms. I've mentioned one simple thing here, and that is in modeling how these systems behave, it's important to model this heterogeneity of participants. And I think this is novel vis-a-vis queuing models that we have studied in other settings, certainly the ones that I've studied, where, for example, we do not study or model different behaviors, but we assume that we're all slightly similar, but maybe we have slightly different parameters between your behavior and my behavior. So this is not what happens in trading systems. And I think this heterogeneity is a first order phenomenon that we need to capture. So the next thing we're going to do is we're going to talk about routing, and we're going to talk about diffusion approximations, and I'm going to pass it to Rama. Okay. So let me stop sharing my screen, and you're going to share your screen. All right.
Yep.
All right.
Okay. Thank you, Costis. So I'm going to take over after what Costis said about queuing. So as you saw, it's a natural approach to model limit order book as a queuing system. And this queuing system operates at high frequency. We have events happening um, over time scales that are of the order of microseconds. So one very natural idea, if you're familiar with queuing theory, is to use heavy traffic approximations to model the high frequency dynamic of these limit order books. And we will see that this is a good idea because it leads to analytical approximations that are much easier to manage than discrete models. And many of the quantities that Costis was referring to, uh, you know, distributions of waiting times, the expected time for execution of an order. Uh, uh, these quantities are involved in the trade-offs where you want to see if you place a market order, limit order. They can become analytically tractable in the asymptotics related to heavy traffic limits. So I'm going to describe here some applications of heavy traffic limits to limit order book modeling and explain why it's interesting and what kind of results you can get from it. So as we saw in Costis' presentation, a limit order book is essentially a discrete queuing system. You have queues at different price levels for buy and sell orders, and there are discrete events, arrivals of new orders or cancellations of orders, execution of orders, which then modifies the state of this queuing system. So you can model it through a discrete model. Here, the idea, well, I mean, in terms of what you want to do with these models, where you want to
Rama,
be,
Rama, sorry. I don't see any slides on my screen.
Oh, okay. So let's see.
Oh, now I see it, but before
Okay.
I wasn't seeing it.
Okay, now is it okay?
Now I can see it. Maybe
Okay.
you can leave it like that.
Yes. So a lot of the applications you saw in Costis' presentation involve optimization, estimation of distributions of various quantities like waiting times or the rates. And this requires some level of analytical tractability for these models. So what we want is a model which is accurate statistically, but also has some analytical tractability to allow to compute the quantities of interest. So one approach that has been used fruitfully in this literature, also in applications, is to model the limit order book as a queuing system. So basically, you need to model arrivals and cancellations of orders at different price levels. Typically, you parameterize this in terms of the distance to the current bid and ask price. So it's a relative price. And then you need to model the execution of orders, which is the rate at which the best queues get served by the market orders of the opposite type. Okay. Now, one of the important remarks is that there's a wide range of timescales at play in this problem. So orders arrive at frequencies which are microseconds or between micro to milliseconds, depending on the market. This is what I would call ultra high frequency. That's the elementary timescale for each event. And that's of the order of the latency of the algorithms which are sending orders or executing orders. Then you have what you can call a high frequency regime, which is around 10 to 100 seconds. So this is the frequency at which many trades get executed. So, for example, if you want to execute a trade, you want to buy 10,000 shares in a stock, you're not going to do it in one shot. You're going to split it, as Costis explained, over a certain time range. You're going to execute 100 orders, for example, of size 100, and that's going to take around seconds or minutes. So that's the time scale of optimal execution. And then you have a daily time scale. That's a time scale at which strategies are developed, trading strategies, option hedging, allocation of portfolios. So these time scales are well separated. So from each time scale to the next, there's at least a factor 100, sometimes a factor 1,000. So immediately you can see that there's something interesting here. means that if we start from a discrete and very complicated model at the ultra-high frequency scale, well, if we are interested in applications such as optimal trade execution, which involve mainly a cost function computed over the high frequency scale, so the lower time scale, then, sorry, the lower frequency scale, then it's a very attractive option to use asymptotics or limit theorems to derive quantities, effective quantities at the larger timescales. And that's exactly what we're going to do, and using familiar techniques from heavy traffic limits of queues. So I'm going to show you how this works in an example. So as you saw, the limit order book has many levels, but if you're interested primarily in price dynamics, how demand and supply moves the price, then essentially you can focus on the best queues, so the queues which have the highest bids and the lowest asks, the highest buy prices and lowest sell prices. So these two queues, the best queues, that's where the action is in terms of how the price is determined. And so one idea is to build a reduced form model where you only focus on these two queues, bid and ask queue, and so their location, that's the buy, bid and ask price, and then the size of these queues, which are QA and QB. Okay, so you look at the best queues on each side, and then we're going to see how we model the rest. So now you say, well, okay, well, I have the best queues, but when this queue gets depleted, I'm going to move to the next one. But how do I know what the next one is if I'm only modeling the best one? Well, the idea is that think of the order book as a stationary queuing system. Well, every time the best queue gets depleted, you move to the next one. So the next one in a stationary regime will have a distribution in terms of its size. And if I call F the distribution of the size of the next best queue, then what I can do is I can think of the rest of the order book as a reservoir of liquidity. And as long as the price hasn't changed, I'm just dealing with the best queue. So I model how the best queue moves up and down under the order flow. And when the best queue gets depleted, I'm going to draw a random variable representing the size of the next best queue from this distribution F, which is precisely the, I can think of it as a stationary distribution of the size of the next best queue. So in this way, you model only the best queue, so we have a drastic reduction in dimension, and then you model the rest of the order book as some kind of stationary reservoir, which just injects liquidity whenever the liquidity in the best queue gets depleted. And of course, you can study empirically what the distribution of the next best queue looks like. So this is the distribution of queue sizes right after a price move. So when you jump to the next best, and well, you have some distribution which has some scale and so on. So this is so we summarize the rest of the order book, which we're not modeling, by a single the distribution. So the idea is that this queuing system is regenerated at each hitting time. When one of the two queues hits 0, you regenerate both queues by drawing a new value from this distribution. Okay, now, and then the other simplifying assumption is that, well, if you look at the bid-ask spread for these stocks, well, the bid-ask spread for liquid stocks is very tight, meaning that it's almost always equal to the minimum size, 1 tick. So that's what we call a large tick stock. So this is, for example, if you look at these stocks, Citigroup, General Electric, well, these are very liquidly traded stocks. 98.82% of the observations correspond to a spread equal to 1 tick. This means that if the spread widens, if one of the queues gets depleted, very quickly somebody feels that, and so you go back to 1 tick. So it means it's a good approximation for these stocks to assume that the spread is equal to 1 tick, and that you focus on the best queues. And then this drastically simplifies the model, because then you have two dimensional queuing system, and you're going to analyze the interaction between these two queues. And the dynamics of the price is determined entirely by the dynamics of the two queues, because if one of the queues gets depleted, then the price moves in that direction. So if the bid queue gets depleted, you move down, and if ask queue gets depleted, you move up. So then the price dynamics is determined by the number of hitting times of 0 by either of the queues, going up or down. Okay, so basically now what you need to model is the dynamics of these two queues. So orders arrive, get canceled, and get executed. So they're inputs and outputs. And so we model this as a market point process. So their event times and their event sizes. The sizes can be positive or negative depending whether it's a cancel or a new arrival. So you have this order flow at each level, and you can think of this order flow as some point process. There can be a lot of dependence in this, and so there are various ways to model this point process. The simplest model is, of course, to model this as a MM1 queue at each level, and then you can have some dependence. This is one model that was studied in detail in the literature. Then you get a limit order book, which each level will describe a birth-death process, and you can derive explicit formulas for the durations between price changes, distribution of time to execution of limit orders, probability of the price increasing conditional on the queue sizes. So these are useful quantities, but they rely on a very strong assumption, that is that it's a Markov process with exponential inter-arrival times, unit size for the orders, and so on. So a lot of assumptions here. Now, if you look at the data, however, well, these assumptions do not seem to hold. For example, the durations between arrivals are not exponentially distributed. So here is the quantile plot of the inter-event durations against an exponential distribution. So if they were exponential, you would see the blue data points on the red dotted line. They're not. Obviously, it's much more heavy-tailed. Order sizes are not unit either. They're not equal at all. There's a large heterogeneity in order sizes. This is order sizes for one stock at the ask city group on one particular day. This is a very liquid stock. You can see that order sizes can vary between 100 and 3,000 shares, and you have a large number of a high variability at the opening and the close. So it doesn't seem like these assumptions hold. So the question is, how robust are the results to these assumptions, and are there results that are valid in some asymptotic sense without having to specify the functional form of these distributions, which we really don't know anyway. So the idea is that we're going to exploit this separation of timescales and look at a heavy traffic limit. And as you know from queuing theory, the heavy traffic limit of a queuing system doesn't depend too much on the details of the distributions of arrival times and event sizes. It only depends on the first two moments in certain scaling regimes. So the idea is what scaling regime is the appropriate one. So here is a picture which tells you immediately what scaling regime is the appropriate one. So for this same stock city group, we look at the net order flow. So net buys minus sells, so net arrivals minus cancellations for the bid size on the x-axis and for the ask size on the y-axis. So you have net arrivals of buys minus cancellations on the x-axis and net arrivals of sales minus cancellations on the y-axis. And you can see that this process, well, it pretty much looks like a diffusion. So it's really, it means that diffusive dynamics, a diffusion limit, is the appropriate limit for modeling the intraday dynamics of order flow. So this is what we're going to do. We're going to look at this queuing system in a diffusion scaling. Now, so this is the net order flow. What about the queue size itself? Well, the queue size cannot go negative. So what happens with the queue size is this. You start from queue size. So we're in dimension 2. We have two queues by bid and ask. So we start somewhere here. And then you diffuse. So the order sizes, the orders arrive, they get canceled. So this leads to a two-dimensional motion in the orthent, which is very much a diffusive one. This is again for 1 day at millisecond level. And then at some point, one of the queues gets depleted. In this case, it's the ask queue that gets depleted. You hit 0. And this means the price is going to increase. The price is going to increase, but at the same time, you move to the next queue. So the next queue is not 0, it's at some value. And simultaneously, the opposite queue moves. So you jump from here to some other point, which represents now the two best queues, the two new best queues. And then again, you diffuse, orders arrive, get canceled, orders arrive, get canceled, until, in this case, the bid queue gets depleted, and then you have a price decrease. So you can see that in this diffusive limit, the joint dynamics of the bid and ask queues is very interesting. It's a diffusive dynamic inside the orthent, as long as the queues are not depleted. And then from time to time, it hits the axis, either X or Y. When it does so, the price either decreases or increases. But then what happens is that instead of being reflected, it jumps to the interior. So it's a discontinuous reflection. So diffusive dynamics interjected by discontinuous reflection. Of course, in reality, you can see that you can also have jumps inside. These are not really diffusive dynamics. You have some large orders which can create jumps inside the orthent, but that's not very difficult to model. What is new here, if you compare to what you used to in queuing theory, is that you don't have a reflected diffusion, but you have a discontinuously reflected diffusion. You jump into the next queue, and the next queue has no reason to be close to 0. Okay, so why is that so? Well, what we can show is that, this simple queuing model I showed you, if you start from the simple queuing model and use a general point process for modeling the arrivals and cancellations at the two queues, then this simple queuing model, under some assumptions, has a diffusion scaling limit, a diffusion approximation, which exactly does what I showed you there. So you scale time by n. So think of the high frequency of arrivals. That's the idea. And then the queue size, you have to scale it by square root of the intensity. And then under fairly but general assumptions that the interarrival times are stationary sequences which converge to 1 over lambda, so they have a non-zero limit. This is true for IID arrival times, but they're also true for Hawk's process. They're also true from some econometric models used in high-frequency econometrics. You have that under these assumptions, and then a similar scaling assumption on the sizes of the trades. What you have is that indeed the rescaled queue size does converge to a process which does exactly what we saw in the picture. It behaves like a planar Brownian motion with some covariance matrix, and the covariance matrix here includes the variance of the order sizes per unit time arriving at the bid and ask, plus the correlation between the order flow at the bid and the ask. And then this is the behavior inside the orthent, as long as the queues are not touching 0. And when you touch 0, well, you jump to a new value inside the orthent, which has some distribution f, which is the distribution of the sizes of queues after a price change. Okay, so that's how we model the rest of the queue. And so I'm going to skip the proof, but what's interesting here, what's not present in queuing theory, is the price dynamic. So here, the queues are not just in abstract space, they are labeled by a price. So every time one of the queues gets depleted, the price either increases or decreases. So at the time scale of the diffusion limit that I just described, the queues have diffusive limits, but the price is a discrete process. It increases by 1 unit when the ask queue at the hitting time of 0 of the ask queue, and it's but decreased by 1 unit at the hitting time of 0 by the bid queue. So it's a piecewise constant process, which is what the price looks like if you look at high frequency. But it's a piecewise constant process whose jump times are the hitting times of a two-dimensional queuing process. So this is a interesting example. So it's linked to the occupation time of the axes, if you want. So it's the occupation time of the x-axis minus the occupation time of the y-axis. That's what the price will look like. Now, this model is analytically tractable. So even if you start from a messy, discrete model with horrible distributions, the diffusion limit that I just described is tractable. You can compute practically anything. The duration between price changes has a closed form distribution. You can calculate the tail. You can look at forecasting of prices. You can see, if I see an order book with size X at the queue, at the bid queue, and size Y at the ask queue, conditional on this, can I forecast the probability that the price will increase? Well, intuitively, yes. And in fact, you have a very simple closed form expression, which is shown here. It's here. So knowing the two queue sizes and their variance and the correlation, you can compute, you can forecast price moves based on that. And this is a comparison of this formula, the diffusion limit to data for Citigroup. You can see that it is in the right ballpark, and you can refine this by adding size and so on. Also, this model, this formula is based on the relation between imbalance between bid and ask and the price, and this is something that empirically is understood very well. And if you have more buys than sells, this is going to push up the price, and the opposite if you have more sells than buys. And here you have this analytical expression which makes this relation very precise. Okay, now the price at this time scale is still a discrete piecewise constant process, as we saw, which jumps at these hitting times. But here you can do a second diffusion limit. So remember, we had 3 time scales: ultra high frequency, millisecond, then you had second. So we're describing what's happening at the second. At the second time level, the queues but diffuse, but the price is still piecewise constant. But if you go to the daily level or hours, well, then the price has a diffusive dynamic. It's modeled by diffusions at that time scale. So how does that link with what I just said? Well, it means that you have to take a second diffusion limit, where now you go to the time scale, which is hours or day. And this means you take this price process that I just described as discrete, and then you accelerate again time, and you do the diffusion scaling. So this for the second time. And then you can see that you get a diffusion. So the price, this discrete price, when you go to a second diffusion limit, you will get a Brownian motion with some volatility. Okay, so this is not very surprising. What's interesting here is the expression of this volatility. So this volatility can be expressed in terms of features, which are the microstructural features that we had at the highest frequency level. So you can see the volatility of the price will be expressed as pi times the tick size, so the unit by which the price jumps every time the queue gets depleted. And then here we have the variance of queue sizes, the variance of order sizes, the arrival rate of orders, and then you have here an expression which involves this distribution f, from which you draw the new queue every time you get depleted. So you can think of this as a depth, a measure of depth of the order book. So you can see that all these features are can be extracted from order flow. So on the left, you have a volatility of a price, so variance of price changes. And on the right, you have an expression which does not involve observation of the price. You can entirely estimate the right-hand side from order flow. So this is interesting. It's not a trivial relation. It's testable, however. You can extract this from data compared with the actual variance of price changes intraday and see how it works. So that's what we did. So here it is. So here we're comparing the empirical standard deviation of 10-minute returns of some stocks for S&P 500 stocks. So each point is one of the S&P 500 stocks. And we're comparing that, which is purely based on price observations, to the formula I showed you, which is a diffusion limit for formula, which gives you a theoretical expression for the volatility purely based on parameters estimated from order flow, from the inflow of orders into the queue, their size, the variance of the size, and so on. And as you can see, it's a pretty good agreement. And there is a dispersion around it. The dispersion is expected because this is a very coarse model, but you can see that the order of magnitude is correct, and in fact, it's a pretty unbiased estimator if you can look what's happening cross sectionally. Okay, so now this is just a simple model with two queues. It can be elaborated further. You can make. I had constant arrival rates here. You can make them state dependent. You can, instead of modeling the rest of the queuing system as just through this distribution and regenerating everything through IID draws, you can say, well, I want to model explicitly the next best queues. This has been done, for example, in a very detailed model by Almos, Lahotsky, Shreve, and Yu. There you have 6 queues. There can be empty queues, and then there's the best queue, and there are next best queues, 3 on each side. So that leads to quite sophisticated dynamics, and they also study the diffusion limit. Other types of extensions are that, well, instead of just modeling 6 queues, why not model the entire order book? And there also you can look at diffusion limit type models. There you get a stochastic partial differential equation where you think here of the order book as a density. So you model it to the density of orders at the distance x from the bid price. And you can show that this density is the solution of a partial differential equation with some noise, which comes from the imbalance at the bid ask. So these are all analytically retractable models in the diffusion limit, notwithstanding their complexity. They still lead to explicit formulas for various quantities of interest. So so that was what I wanted to say. I wanted to show you some examples where we can use techniques from queuing theory, in this case heavy traffic limit function central limit theorems, to simplify the complexity of these discrete models, which look very daunting when you look at all the details, high frequency dynamics. In fact, the fact that things happen at high frequency help us to drastically simplify the reduced dimension, and then this gives us analytical insights into the link between the behavior at different frequencies and between order flow properties and price dynamics. And in financial terms, you can think of it as linking liquidity of the market to price behavior, which is a central issue in market microstructure. So I will stop here, and you have some references where you can explore more. So I hope that we will have some interaction after the tutorial session. Thank you very much.
All right. Thank you from me as well. Hopefully we'll get some Q&A discussion going. Thank you.